Hi, everybody. Welcome back to the channel. You're here with Earl, the money coach, and we're talking about annuities, specifically fixed index annuities. Okay, so if you're looking for retirement plans, how to roll over a 401k into annuities directly, this video is for you. If you're trying to protect your retirement, or you say, hey, I still may have some time to have a little bit of growth potential, but don't want to have any market losses, this is a great strategy for you guys. I'm going to break it down, how it works, the pros and cons, give you guys some numbers so you can make an informed decision. And if you want help, reach out. We can schedule a consultation. But make sure you guys like, follow, and subscribe, and make sure you stay to the end so you hear how these things work. But first and foremost, what is a fixed index annuity? Okay, first off, so you know, it's nothing more than a insurance policy. Okay, fixed index annuities, it's insurance based, okay, which allows you to reflect the market but not being in the market, meaning that since you're not directly in the market, you're not worried about those market losses, okay? But since it's still in things like the S&P 500, the NASDAQ, where it's reflecting, when you have market gains, guess what? You could also get some of those upside potentials without worrying about any losses. So now they normally have what they call caps. Now what that means is you have a cap or a participation rate, which allows you to get up to a certain amount. I'll kind of break that down the road so you consider what that is. But if you have a 401k and you're considering rolling that into a fixed index annuity, why would you want to do that? Well, number one, if you want guaranteed protection, MCP, I call that market correction protection. Guess what? You don't have to worry about any losses. It could give you steady income for retirement. That's where it could be a smart choice. Plus, the money that you contribute is growing tax deferred, meaning that you don't pay taxes until you take the money out. All right. And then it depends how the money goes in, if it's even taxed at all. So many people think you have to roll over your 401k into an IRA first, but that's not always the case. Some 401k plans, okay, they allow you to roll over directly into a fixed index annuity, which simplifies the process. So the different ways to do that. So step number one, make sure you check with your 401k plan. That's the very first thing you got to do. You got to see what could be done, how it could be done, if you're still working, if you could do in-service distributions. Okay, check with your HR or your benefits department, because not all plans allow rollovers to be direct. You have to understand that. So it's important, super important, to confirm that it does. All right, and then you want to ask questions, man. A lot of people, they just see stuff. Look, ask questions. Ask them, look, can you roll over part of your 401k, or does it have to be the whole thing? Does the plan offer specific, fixed index annuity options, or can you use an external provider? Are there any restrictions? Are there any fees? You need to ask these questions. These steps are critical because most people just don't understand. Because if your plan doesn't allow it, you'll need to explore other options. This is not for everybody, so you know. Now, after that, that's step one. Step two is choose your fixed index annuity provider. Okay, once you know what your plan allows, or if it's an old 401k, what it could be done, you could do with it. Your next step is considering which is the best one. Sometimes your 401k administrators, they may work with specific companies, or they have some which allow you to do stuff on your own. If you want to pick a reputable external provider, I tell people, look for companies with strong financial ratings. You're going to hear double A or triple A ratings. Check their track record. Make sure you see all that. Why? Because you want to make sure that your savings plan is with a solid insurer. Okay, that's number two. Now, step number three, understand the terms. There are different terms and ways how you structure your fixed index annuity. Before you even do anything, you need to understand some key terms. I'll break some of them down. Number one is participation rate. Okay, see, what is the participation rate? This is the percentage of the index that you could gain within a fixed index annuity. So if you have a participation rate of say 80%, right, and the market goes up 10%, you're going to get 80% of that gain. So that means you'll get 8%. Okay. Then you have to know about your cap rate. That's the maximum return that annuities could give in a specific or any given period. So same example, let's say your cap is 8%, but the market goes to 11, you're only going to get 8% that year. Okay, then you have your guaranteed minimum interest. Okay, even if the market performs poorly, you still earn a guaranteed interest rate. Most companies do a 0.00. Some of them may do 2 to 3%. It all depends. But here's the big one, folks: surrender charges. If you withdraw money early, usually you're going to have penalties. And if you want to cancel everything out, you have a surrender charge, which is regularly over the period of your policy. So that's huge to understand. So once you know those terms, step number 4 is to initiate the rollover transfer. So you figured out what you could do. You figured out the best company. So when you're ready, figure out from the 401k administrator or the external provider, let them know you're ready to initiate it. The transfer is done directly, which means your money is moving directly from your 401k to the FIA without you taking any distributions. That's important because if that money comes into your account and you start taking it, or you have early withdrawal penalties, it could be a lot. So make sure that you understand, you complete all the paperwork, you have everything for your records, so you know you're not going to have to worry about any of these things. And then step number 5, folks, please review your contract carefully after the rollover. These are very complex. I tell people with annuities, there's a lot of lingo, understanding what it is, making sure, because you're locking yourself into a time period. It could be, 5 years, 7 years, 10 years, 14 years. Make sure you know what that is when you're reviewing. Understand how interest is credited. Understand what the surrender period is, if it's going to be 10 years or 12 years, whatever it may be. Whether there's an income rider, if you want to have that lifetime income, if that's automatic or do you have to include it? Is it going to be a fee for it? What fees are involved? Because when you add on certain things, I tell people, look, there's going to be some fees. So you want to make sure you understand how all that works. All right. So quick, I always tell people you can also get bonuses. Some companies are allowing you to get bonuses when you roll your money over. And why is that important? Because sometimes they'll do that to compensate for taxation. So, hey, you could get a 22, 23% bonus. If you move this money, you're probably going to have 15% in taxes, something to cover everything. So I tell people all the time, look, if you have these, you want to see how it's utilized. Okay, if you're going to have the bonus to take care of taxation, if you're going to have the bonus just so you can get more immediate income up front, if you're going to elect a bonus because you want to have it as a growth strategy instead of immediate income, see what they do, because a lot of companies are able to give you bonuses on top of the principal. Just had a client, they had $300,000. The company gave them a 27% bonus. So day one, they started with $381,000. So that's huge. Now, what are some of the pros and cons, of these kind of strategies? Because I want to be fair, don't want to be biased. I want you to understand everything. So some of the pros, obviously, you're protecting your principal. You put $100,000 into an annuity, that 100,000 grows to 400,000. You know your 100,000 principal is good to go. You got potential for lifetime income through the riders. Okay, it could be done directly without having to go through any 401ks. So you have some pros, but also understand there's going to be some cons. Okay, you have limited liquid, meaning generally if it's a 7-year annuity, look, you could only just say 7 to 10% every year until that time is up. So you want to make sure you understand how that is. You have your caps and your participation rate, so you will not get as much if you have that money into a regular strategy. Withdrawals can be taxed as ordinary income. So you got to understand if it's qualified or non-qualified when you're moving your funds over. Most of the time it's qualified, meaning it's qualified to be taxed because your 401k didn't have taxes from the start. Okay, so I tell people, understand that with the rules of the annuity contracts, because that could be huge. Now, it's a good plan, I always say, to have supplemental income. You don't need to have all your money here. To say you have 400,000 in retirement, maybe put 100,000 in IRA, 100,000 into the stocks, 100,000 into annuities. You see, spread everything out. You don't want to have all your eggs in one basket. This is a great strategy where you can have multiple eggs, but put some of your eggs in this strategy that gives you guaranteed growth, steady growth potential, guaranteed you're not losing money in the market. It gives you kind of a win-win. It's more of a, if I had to break fixed index annuities down, folks, it's more of a get rich slow. You're going to make money over the lifetime of your annuity. It's not something that you got $100,000 this year, next year is going to go to 200,000. No, it's not. It's a 7-year, 10-year contract, so your 100,000 grows to 400,000 down the road, right? In the next 10 years or so. So you got to understand it's something that you want to be able to build up that gives you MCP, market correction protection, and ultimately, it's a huge thing you could have for your 401ks to roll directly into an annuity, so you're not worried about touching the money or incurring any taxation. So, folks, I hope this was some great information. And if you love what you heard, make sure you like, follow, and subscribe. And if you need any helps or any illustrations or to see what you could do when it comes to a fixed index annuity, make sure you reach out. You can schedule a consultation with me and we can see how that could work for you. And I'll see you on the next video. Take care.